Levinson. I'm the Executive Director of WIDA. We have a lot of new faces in the room. I told a few folks this, but this is, I think, our biggest policy event in the history of the organization. Obviously, there's a lot of interest. We normally, our events typically are about 100 to 120 people. We had 220 RSVPs for this, which is as many seats as we could get in the room with the format we have today. Obviously, it's a reflection on the interest in the topic and the speakers we've lined up. We're delighted to have you here. As folks know, WIDA is nonpartisan. We don't take positions on issues, so we are trying to be as neutral a forum as we can be, invite all sides to have a conversation and to help educate the policy community, whether you're private sector, think tanks in the government, in the U.S. government, and in foreign governments, to learn as much as we can about the issues. Following this event, we're going to be hosting an event on renegotiation of NAFTA. What would that look like? We'll be announcing the speakers for that either later today or tomorrow. There's information about that in the back. We're going to be having a look at U.S.-China trade relations, which is also a hot topic. And we have other programming in the pipeline, hope to announce very, very shortly. We will be addressing these issues both through our policy events and on our websites. You can look at americastradepolicy.com. And a number of folks here have been talking about some of the things we're doing with our next Gen Trade agenda, which is to look at the future of trade, future of business, and where that's going. Obviously, that's informed by the current policy debate, but also decisions that businesses are making in how they see the future of their business customers, the technology, the economies. For this event, several of us have been wanting to bridge the gap between the tax and trade worlds for a long time. And we've had a lot of interest expressed from WIDA members. A lot of the people who typically work on trade don't always work on the tax issues. Kathy Schultz, our moderator, is going to walk through a little bit of kind of that nexus of tax and trade for those of you who are not regulars in the tax world, which I think is a large part of our audience today. Try to keep this at as basic a level as we can on the tax side, because I know a lot of you know about the trade issues, but we also have John Verino here to talk about the trade aspects. And very pleased to have Dan Mitchell and Gordon Gray for this first panel. They'll have a discussion, make individual presentations, take some Q&A from the audience, and then we'll turn to our second panel at about 10 o'clock. Thanks, Kathy. Someone asked to remind folks to turn your ringers off, please. Thank you.
Welcome, everybody. I'm going to try to give a very high overview of sort of how we got here and, where did this all come from. As far as tax reform, a lot of folks are saying, why tax reform and why now? It's really not a now. Tax reform has been being pushed by the business community for many years. There's probably already been 60 hearings in the Ways and Means and Finance Committee. This is one issue that has both bicameral and bipartisan support. Everybody's in agreement that the tax code is broken and needs to be reformed. What the shape of that reform is going to be, I think, is the biggest question. But I think just in general, everybody decides that our tax code ought to be fixed. From the business community standpoint, the last time we did tax reform was in 1986, and we have gradually lost our place in the world. We are we have the highest corporate tax rate of any of the developed world. We also are under attack in many other countries. There is a project that has been going on for several years at the OECD. It's on base erosion and profit shifting. There is also several state aid cases in the EU, and all of these projects are targeting basically U.S. multinational corporations. And a big part of it is because our tax code is broken, companies have done a lot of tax planning to try to do some self-help, to try to fix their tax rates so that they can be more competitive as they move through the world. Chairman Camp, the former chairman of the House Ways and Means Committee, put out a document a few years back, right before the end of his term, and it was called HR 1. It was the first sort of really big comprehensive tax package that was put on the table in a lot of years. It went nowhere. It had a lot of problems. There was a lot of provisions that the business community didn't like. As the House Republicans got ready for the election, they decided they had to put together several different blueprints explaining sort of what their policies were going to be and to have something to run on. As part of that, the Ways and Means Committee, with the help of Speaker Ryan, put together a blueprint for tax reform. It's not a large document, it doesn't have a lot of detail in it, but it did include several new concepts that people started to talk about. But it didn't get a lot of play until after November 8th. There were a lot of folks who did not anticipate the result of the election, and when it was determined, obviously, that we had Republicans win the House, the Senate, and the White House, all of a sudden the blueprint became a lot more critical, and folks who hadn't really paid a lot of attention when it came out in June started to pay very close attention to it. As part of that blueprint, Chairman Brady has put together a different type of tax system than we are used to. It is called the destination-based cash flow tax, but it is commonly called the border adjustability tax, or BAT. Part of the reason that they put this provision in place was there is concern that the rest of the world, 180 countries, have a value-added tax system, which is a consumption tax paid by the consumer but collected along the way through the supply chain by business. That tax is adjustable at the border because it's a consumption tax that the countries assume that if they remove the consumption tax at the border, as soon as the good or services crosses the border, it gets taxed in the next jurisdiction. Because the U.S. does not have a value-added tax or any type of federal consumption tax, it was considered discriminatory against the U.S. because those products and services were coming into the U.S. without that additional tax that was rebated at the border. Part of the reason for doing this destination-based cash flow tax was to try to equalize that treatment so that products coming into the U.S. would be taxed just as our products are taxed when they are imported into other countries. As part of the destination cash flow tax, you also have to look at sort of some of the other pieces of the tax code that go along with that. Part of that is that there's immediate expensing of everything that folks buy. We're no longer going to do long depreciation tables, and interest deductibility is gone. So as part of moving to a new type of tax, you are also changing some of the fundamental parts of our tax code. This provision raises $1.2 trillion, according to several different calculations, and Chairman Brady has been calling it the backbone of tax reform. It basically gives deductions and breaks to companies who are exporting and adds that tax back in on the bottom line of companies who are importing. So there's a distinction between how exports are treated and imports are treated. As you may have heard, there's a lot of talk about Buy American and making sure that the U.S. can compete on a global basis. This is a key part of the Ways and Means package. There's a lot that we don't know about it yet, simply because we have a blueprint, but we don't have technical details yet. So as we move forward, we will have a lot more detail on how this is going to work. But for right now, we are moving forward with tax reform. This border adjustability tax is a huge part of what Chairman Brady has been saying will be the backbone of his package, and we are not sure where the Senate's going to be on it. We don't know where else this is going to be on the House. This is a new concept in how the U.S. is going to be doing taxes. It is not a consumption tax, it is a consumption-like tax. And because it is a very different system, there is no other country in the world right now that has a destination-based cash flow tax. We're not sure how everyone else is going to react to it. But we're going to go and walk through sort of the upside and the downside of it and give some of the trade implications. And as Ken said, the second panel will get a little bit more detail on how companies feel about this. So I'm going to turn it over to Gordon and let him explain, sort of the positives.